stocks and what's moving. What do we have? Opening bell, first trades on your screen. The Nifty is starting about 0.1% lower, nothing. 24,674. So 686 is that gap area. We'll see if that is able to be held on. The bigger one, of course, is the 20-day, etc. That's slightly lower, though. The Nifty Bank is down about 0.25%. 50,671 is where the Nifty Bank is opening at. A little low, a little more pressure on the Bank Nifty as compared to the Nifty at the word go. IT index, which has had a fantastic run from last Friday on, is starting about 0.25% lower as well. So that is the Nifty IT index. It's more evenly balanced. Last two days, Monday, Tuesday, we had just 5-6 stocks in Nifty starting in the green. But look at the heat map there. I think there are more down than what is up at this stage. 20-point lower on the Nifty. Surbhi.
Okay. By the way, I want to start with the shipbuilders once again. Because there's so much news flow around them because of this one report from ICICI Securities. Mazagon Dock is again down 3.5%. Just note that. We'll be speaking with the management in a short while from now. But the starting tick is negative on these. Garden Reach as well, 0.5% lower. And the other one, Cochin Shipyard, also 0.5% lower. So let's see how this goes and whether these dips get bought. Anyway, back to the headline indices. Flat trends on the Nifty right now. So the weak hands include actually some of the financials which were powering through yesterday. Shriram Finance, these stocks were up 3, 4, 5%. So today they are leading on the way down. Shriram Finance, HDFC Bank, Axis Bank, you've got ICICI Bank, State Bank of India, Kotak. So basically, the entire financials universe is on the lower side as we start off with. And then you have a couple of the material stocks, metals, materials, commodities. Tata Steel about 0.25% lower. Grasim is down about 0.25% as well. So is Ultratech. So not too much of a cut here. Which is basically a little shade of a red on some of these names. ONGC as well. So basically metals, materials, commodities on the lower side. On the upside, Bharti Airtel is holding out quite positively. The stock sold off a lot yesterday. It was the weakest performer of the Nifty. There's a bit of a reversal today. The subscriber additions are not too bad. Mild additions month on month for Bharti Airtel. For Jio, there's been a dip. Reliance is actually slightly lower right now as we speak, just about 0.2% lower on Reliance Industries. But yes, some of the life insurers, they're still catching the attention. So HDFC Life is still up about 0.5%. SBI Life is a little more quiet, but otherwise very, very flat on the index. Not too much moving, at least as of now. DRL, Nestle, HUL, Titan, that gives you the drift. That's the green side. So again, it's a bit of a morning that starts off with some of the perceived safe havens, some of the defenses in the green.
Well, that's right, Surbhi. And in fact, there are a couple of stocks that are doing very, very well. So the headline index, we're as flat as can be, but you have two stocks that are advancing for every one stock that's declining. Tell you there's plenty happening actually in the broader markets. A few stocks to note. Genius Power, the big order win, second one, I think, in the last 1 week or so. The stock is in upper circuit, up closer around 5%. So big up move is what we're seeing on that one on very, very large volumes. Reliance Power, well, that one as well has been moving circuit to circuit. The street believes there could be a deal in the offing, so let's see whether or not that takes place. But that's one of the top volume movers. So Reliance Power is well locked up, 5%. JMR Power, that's another one that's up closer to 2.5%, but it's one of the top volume movers today. So that's why just highlighting that stock. Big move is what we're seeing on that. Nuclear Software, well, that initial tick was up closer around 6%. So pull up that stock. That one's doing quite well today. Godfrey Phillips, that one's pulling back a little bit. It's down closer around 3% odd. So that one's cooling off a little bit. And DCX Systems, that's another stock here. Influential HNI investors that were picking up stake out there. The stock has seen a correction from the recent peak. But today as well, the stock is a little bit subdued. Another stock that we highlighted earlier in our morning chat was India Mart. It's come out of the F&O ban. Sometimes you see a bit of a move, and that's precisely what's happened. So from the F&O list, India Mart is one of the top movers, up close to around 2.5%. And Nippon Life as well, up close to around 2%. What's not doing too well? Pyramidal Enterprises has pulled back a little bit. So a flat start. The good news is the mid-cap index in the green, and you have way more number of stocks that are advancing than declining. Prashant.
All right. Okay, well, that's essentially the what's up and down. We'll sort of highlight more stocks as we go along. But let's welcome in Sanjay Parekh. He's founder and CIO at Soham Asset Managers, who's here to talk markets. Sanjay, great to have you back on the program. Thank you very much for your time. We're usually chatting in the afternoon, so good to see you in the morning for a change. Just a quick word, Sanjay, on the markets themselves, because it seemed like, at least, that many a theme, especially defenses, we were just highlighting, right? I mean, these are themes where people have stayed long for a while, made a lot of money. But once momentum breaks, then it's kind of hard to stay long, because then you start to wonder whether I should lock in the profits that I have, or and then let's see later where does it want to settle. Are we entering that kind of a phase in a few sectors, especially areas like defense? Sanjay?
Yeah, Prashant, absolutely right. I mean, good morning to all of you. So, yeah, clearly these are area of frauds in valuations. The flows from direct retail or certain passive funds dedicated to these sectors also has, because these are passive dedicated sectoral funds, right? So, so they have to buy in as they get subscription. And that is, of course, the direct participation in this such capital raise has caused froth in certain sectors, and certainly one should book profits. I totally agree with you.
So book some profits, okay. Hi, Sanjay, great to have you on. So let's explore that in some more detail. Now, where would you look at trimming positions or booking some of the profits? How are you looking at any portfolio readjustments at this point in time? Give us some more color on it.
Yeah, so Surabhi, good morning. So, our approach is we predominantly large cap. Our average large cap holding has been 80%. We always said at least 70% would be large cap. And I mean, even in large cap, we are at fair value plus. So our approach is be very, very selective. There are ideas very clearly across the board, but the filtering has to be very, very hard. So the main filtering criteria is valuations, right? So while there are opportunities, every month you get opportunities, but there are few now. And that's our approach, that be selective, have aggressive filtering criteria. We think larger caps are overvalued, they're going faster, but 3 to 5% lower, they'll get reasonable and maybe some time correction. So we're not so perturbed with large caps. I mean, 3 to 5% or even a little more is fine, and some more time correction. But in mid and small cap, there are pockets of froth. I'm not saying all of them are frothy, but certainly there are pockets of fraud, defense being one. Some of the themes in railways are also going berserk. At 60, 70, 80 times, I don't know whether there's money to be made, So, and we know the euphoria on the flow side, So that is also where we are worried, and we are clearly going to stay away from such segment. And selectively, as I said, in large cap, mid cap, small cap, you do get opportunities. And that's what we are looking out for.
All right. Hi, Sanjay. Good to see you in this morning. And you mentioned in the past, I think L&T is something that you like. You prefer them in comparison to the other names that are trading at very elevated valuations. Coming back to you, Sanjay, and I wanted your thoughts on Ola Electric, but I wanted to focus on the stock of the morning, actually, Mazagon. We are talking about that stock being lower. Just pull up the intraday chart. The intraday chart will tell you from the lows of the day, in a matter of minutes, the stock is up close to around 8% or thereabouts. At some point of time, the director will put that up for our viewers on the screen as well. But Sanjay, what about Ola Electric? At IPO price, people were debating. Well, the stock has almost doubled.
No, it's surprised. I'll be very honest. We've not participated, but there were few colleagues who were positive and they participated in funds also. And definitely, such a big move, you certainly have to introspect, right? So we've not participated. Having said that, there are comparisons you saw yesterday with Hero versus Ola, and those needs to be kept in mind, Some companies are made in 50 years, and some of these new generation companies, they speed up so fast, and execution is certainly important. Having said that, we certainly not undermining the strength of this new generation companies. They're phenomenal companies with great products, great pipeline, and definitely very, very positive. But just that valuation is discomforting, at least not in our style of growth at reasonable price.
Okay, all right. So you're choosing to give that a miss, but what would you rather play? Because you like the theme. The EV theme is something that's definitely going to take shape in the next few years. By 2030, various estimates suggest that there'll be a far larger, exposure to EVs. So in that context, Ola valuations, well, debatable out there. But what else do you like then from the auto
So,
space?
we're very positive on ancillaries which are catering to this or transiting them. We have two of them, one of them transiting towards that segment, Sansera, and even some Samel, Samadhan Motherson, certainly is very, very well poised when the EV segment takes off because it's actually agnostic, all the products that it has. So we're very well poised on that side, I mean, as it takes off. And then overall renewable also, we are on the power space, we are there. On the EPC space, we have Solar Wilson. So we like the theme and we have participated, but we would want to participate in a stocks where they are reasonable price and reasonably valued at our end.
Okay. Nigel, just to go back to the shipbuilders, we've got to fire those stocks up because the classic bull versus bear playing out on a Mazagon Dock, on a Cochin shipyard, on a Garden Reach right now. These stocks open slightly lower. Let's get the stocks up on the screen if we can. They opened slightly lower. Yesterday, the declines were as much as 9% on some of the stocks. And today, the start was lower and the dip is getting bought. We're going to be in conversation with the management of Mazagon Dock in about 15 minutes from now. The contention in a report that was put out yesterday, it was a report by ICICI Securities, and it caused a flutter because their target prices are substantially lower, 50, 60, 70% lower from where the stocks are trading at right now. Now, the contention in that report was that for a company like Mazagon, for instance, the best of the revenue recognition will play out over the next 2 years. And after that, margins and EPS, it'll all sort of, peter out and it'll become very range bound. And therefore, ICICI Securities felt that the valuations are simply not justified. Classic bull versus bear. And, right now the bulls are snapping up that stock. Oh, yes, we'll ask the chairman and managing director about the business. Of course, he's not going to talk about the stock and the valuations, but the business, really. Can the growth momentum continue? That's coming up at about 9:50. But, Sanjay, weigh in on this debate. I mean, whether it is some of these shipbuilders or some of these other, for instance, look at a stock like GE today. There's some reorganization by the global parent. They might be selling some stake and, simplifying their holding structure. That stock's on down circuit right now. But again, I mean, whether it's shipbuilders, whether it's these MNC capital goods plays, they're fetching top dollar in terms of valuation. Where do you think it still makes sense to hold, if not buy fresh?
I think, the government, which is the largest owner of this, should provide the supply. I think, they understand the valuation. We saw the whole PSU basket at 13-14 lakh crore. Today it's 65 lakh crore. So I think the government should suffice this demand or euphoria by providing supply. That would be a very good thing because it will mean monetization by the government and then giving the supply where there is hunger, either through passive funds or through direct. And that, I think, is a very, very smart strategy that government should do of providing supply in all the stocks, because the valuations are really good for them to monetize. And that should be at least, I think, because, as I told you, right, 60, 70, 80 times just doesn't fit in our strategy. We would not be participating, and that's our approach. But government clearly can monetize.
All right, interesting. Yeah, I mean, could make sense for the government to take some money off the table. But talking about government taking money off the table, they didn't do it. Vedanta stock, I think that you've been fairly positive on, and the promoter's been making the right moves. They went ahead and they took some money off the table in Hindustan Zinc. What's the view on that one? Because, this one has been a very, very dicey one and tricky to play with the promoter, mostly not making moves in a linear manner. But now the street is quite excited. Your view?
Yeah, Nigel, so you all have covered it so well, and I think they're making all the right moves. We luckily got it way early. And then we participated even a little lower than current price as well. I think here the worry was the parent's leverage at 6 billion was discomforting. And, the promoter is consistently doing the right things. And I'm very, very confident that, they will get it to $4.5 billion of debt as a first milepost. And once they reach there, then, the risk significantly reduced, which was a hangover for the stock. And then, the business, we always, in terms of their execution, the way they run the business is absolutely impeccable. And then it will be towards this business. And the HZL monetization, I think, is a very smart move because, HZL we paid the dividends to Vedanta, and Vedanta in turn should effectively pay 13 rupees. They've already paid, I think, 15 rupees. So 28 rupees dividend in the last 6 months you got. which at least we were looking yesterday, it's 9% on our cost as a yield. So, and then you also getting growth. So I still feel that it is undervalued. The promoter has to make the right moves towards creating value, which it is doing.
Sanjay, this is not about what you own, but what you don't own. And correct me if I'm wrong, you don't have exposure to insurance as a space. That's cited by a few investors as a combination at this stage of the market where there is some valuation comfort and there is growth visibility as well. Not very high growth, but there is growth. And the other is healthcare. I think pharma, etc. I think you don't have any exposure. You know, I mean, of course, I mean, you can't own everything, but I just wanted your thoughts on these two areas.
Yes, so we have Sun Pharma and Aurobindo on the pharma space. We don't have hospitals and the healthcare space. That is what we have. And the earlier one you asked, I missed it. Sorry. The other one.
Insurance.
Yes, so insurance. You know, we genuinely looking at both SBI Life and HDFC Life. They are good defensives. They come out of those low growth phase, and now you know there. Of course, the growth is more from ULIPs. But I think they are now reasonable on valuation. We don't own in our AIF, but we own in our PMS. We're looking at it very positively to buy at the right price. One of them.
All right. That's the view coming in from Sanjay Parekh at Soham Asset Managers. We've got the market, which, by the way, is down about 17 points or so. And we've got... lots of stuff moving around as far as overall market is concerned. Just too early to look at the overall market breadth. We'll do that in a bit from now. But be rest assured, I mean, the index can tell you whatever. There is a lot of stuff moving up. I think more up than down by far. On your screen, 1600 to 600 advances to declines ratio. Guys.
All right. Well, let's focus on our next company. Then we have Allcargo Logistics. The stock is in focus. It was buzzing in trade yesterday. Well, it reported the highest ever monthly volume growth for the month of July. To discuss this and more, we have Mr. Ravi Jakar, the Chief Strategy Officer at Allcargo Logistics. Hi, Ravi. Good morning, and thanks a lot for joining in. Well, give us a couple of details then. Tell us what's the average freight rate in Q2 if I compare it to Q1, and also what are the volumes you're building in for Q2 and for the remainder of this fiscal as well.
Yeah, so I think, last 4 quarters or a little more than a year, the global trade was in a phase of, a subdued economies in Europe, and the overall trade was down. And we had been anticipating that we'll be coming out of it with inflation easing, with interest rates likely to soften. And we are now witnessing that people are restocking the inventory. So inventory levels are moving up. And typically what happens is, when you move from 3 weeks of inventory to say 5 weeks of inventory, you're essentially providing a 4% sort of a growth on the overall annual volumes. Now, that's the kind of trend we are witnessing right now. And with all the disruptions, the Red Sea crisis continues. We are also finding that the supply-demand imbalances, which had happened in the last 12 months, have also been, balanced out. So we are finding that the freight rates are now more consistently in the higher range. The volumes are rebounding. As a company, both driven by this market improvement as well as our own initiatives, we have reported for the month of July 818,000 cubic meters in LCL, which is almost 5 to 6% higher than last month. It's almost same as the highest ever we reported a couple of years ago when the trade was in a very different cycle. So we are witnessing that this trend should sustain from here. And right through the remainder of the calendar year, we believe the volumes should remain strong. And the good part about this growth is this is not specific to any geography. We have found for the month across the board, be it Americas, parts of Asia, including China and Vietnam, and even European markets have seen an improvement in the LCL volumes. So that's on the LCL trade. On the FCL trade as well, we have seen almost 6% increase over the last year, same month, July to July comparison. So overall, there's a clear sense that markets have confidence that consumption would come back. People are building up inventories, whether it's in US or other parts of the world as well. There are some bright spots, call it out, Indonesia, Vietnam in Asia, India, of course. And then you have some of the Latin American countries like Brazil seeing some growth in trade. So overall, the trade was in a very subdued situation over the last 12 months. But now, since mid of June, we have seen there's a good sharp rebound in trade, and we expect the momentum to continue for the months to follow.
Ravi, if you look at some of the macro-ish data points, what you guys are doing and what many analysts have highlighted is, cost-saving measures and efficiency drives, etc., which is great news for the company. But overall, many are pointing out that we're actually now entering perhaps, after a long time, a synchronized kind of slowdown, especially in terms of global trade. You're telling us actually it's the opposite. You look at what's happening in Europe, you look at what's happening, fears of slowdown in the US, China is where it is. Of course, there'll be hotspots in smaller regions, but just wanted your thoughts, if you can clarify that a little bit more, especially on the container side.
Yeah, so I think, what happens is many a times the global view is more connected to the view of the Western Europe and China. And we know that supply chains have been diversifying. So China hasn't really been the bright spot for the global markets. And Europe in particular is still in a bit of a subdued demand. So, if you look at exports out of Europe in particular and some of the overall consumption, it's still low. But what's happening on a global basis, and, we kind of represent global trade with our breadth of presence across the world, we are clearly witnessing that there are good pockets of growth. And they are more than covering up for the lack of growth in Europe, for an example, compared to what it used to be 2 years ago. And of course, there's diversification. So, India, Vietnam, Indonesia, some of these countries are eating into the share of exports as compared to, what China used to do a couple of years ago. So overall, if you look at the freight rates, because they reflect the supply chain imbalances, I think if you look at just this year, we had almost 1.5 million TEUs of new ship capacity on the container shipping, which came into global trade. And despite that, we have freight rates which have continued to increase from April until about June end, and now they've kind of stabilized in a range-bound manner. And freight rates have remained high. The cargo which was being booked 1 week in advance 6 months ago now requires 2 to 3 weeks of planning at least. So there are clearly on-ground situation which is happening that there is a rebound in trade. The only caution is this rebound in trade at this point in time is also linked to the inventory rebuilding. Now, inventory rebuilding is often on the forecast and assumptions of consumption growth kicking in, and that's something which is expected. And we are seeing some green shoots, but for this growth momentum to sustain, say over 12 to 18 months or longer, it will need to come into that territory wherein interest rates continue to come down. There's more disposable income in the hands of European and the American consumers. They're in a position to increase consumption. So all of those factors will have to continue to play out. But at this point in time, they're clearly seeing elevated freight rates, and that's an indication of renewed global trade demand.
Ravi, hi, morning. It'll be really helpful if you can put some numbers to it, both on the revival in freight rates. What is the increase you've seen so far in Q2 in the last couple of months? If you could just give us some numerical indication. And also, as you're talking about volumes being buoyant for the remainder of the year, again, some rough range that we can work with. What kind of volume growth across both the segments that we can perhaps look at?
So if you could look at the long-term range, we had been talking about LCL industry globally growing at, let's say, 5 to 6%. And on the back of that, company growing double digit. That's been the aspiration. Now, what happened in the last 12 months was industry was perhaps degrowing by 10 to 15%. And that 5 to 6% delta on the company meant that we also saw a decline of 8 to 10% from our peak numbers. Now what we are seeing is that there's a bit of a growth kicking in, which means that instead of a decline, now we're in a phase of marginal growth in the industry. And with our ability to outperform the market, we are now witnessing, like I spoke about, a good 7 to 8% growth, whether you compare last year or last month. So we believe that the growth should be in the range of 2-3% for the months to follow, and should gradually pick up from there as the demand sustains. And we would continue to outperform the market, and therefore we could potentially look at growth numbers going back to where we were aspiring, say 15 to 18 months ago. That's how I would put it in a broad range.
Okay, and just a word also on the international supply chain revenues, because if I look at the trajectory over the last couple of years, that's where there's been a dip from about 17,600 crores in FY24. You were down to about 11,250 odd crores, with margins also dipping. What's the outlook on that business?
So I would say, in the international supply chain business, a large part of our cost and revenue is ocean freight, which is quite volatile. So for our business on international supply chain, one has to look at the gross profit, and that's the right parameter of evaluating how the business is performing. And as we have been sharing information on a monthly basis, that is driven by volume, utilization, and the mix of containers. And in terms of numbers, I can share that our container utilization has increased almost 10% over the last 12 months. The mix of 40 feet containers has increased about 6 to 7% as well. And the volumes are also up. So a combination of all these things should drive gross profit, upwards. And that's how, with the cost conservation that we have done over the last 6 to 9 months in particular, we should be in a position to improve the profit margin. That's been the broad strategy at play. Conserve the cost, which is in our control, and hope for the markets to revive and then outperform. And we're glad that things are starting to play out over the last couple of months now.
All right, and of course, the market's taking note of all of that as well. Thank you very much for joining us, Ravi. Good luck to you, and we'll speak again. Thank you. We'll take a quick commercial break here with news that the market is still down about 15 points, so it's flattish, like how US was, just a drift. I mean, nothing more than that. It's basically broader markets which are still looking very good, with about a 2:1 advances to decline ratio. The largest volume traded name is once again Ola Electric with a 3% gain. And of course, there are many others. We'll highlight some of this stuff in a bit. We'll take a break. We'll also have the management of AkzoNobel India to talk about their business in the quarter gone by, but more importantly, the outlook ahead. Stay tuned, that's coming up. Okay, welcome back. Let's put the spotlight in the paint sector now. And to sort of talk about this, we have Mr. Rajiv Rajgopal, Chairman and Managing Director at AkzoNobel India, joining in. Mr. Rajgopal, good morning. Great to have you with us here on CNBC-TV18. Prashant this side. Let's just talk about, how demand is panning out in the second quarter so far. Did price hikes get absorbed? To what degree? Just give us a color, sir.
Good morning, Prashant. Good morning to you and the viewers. Yes, the price increase happened in two tranches. The first tranche was end of July. The second tranche was around the middle of August, 12th of August. It's too early to really predict because the prices were to a tune of about 1.5%. So it's not really massively significant. But yes, you did see a little bit of a blip during the price increases, as you would, which is basically a little bit of stock up. Yeah, but we continue to sort of focus on driving our volume, like in the last quarter where we had a double-digit volume growth as a consolidated paints and coatings company, driven well by both the paints and the coatings verticals. We continue to be making sure that we are driving our key categories, particularly with focus on premium, making sure that we are competitive in our mass and economy offerings in the paint side, and on our coating side, making sure that we are able to give better value propositions to our customer across our businesses. So suffice to say, Prashant, that initial months, I think it's better than the last quarter, if you ask me. But we've still got a month and a half to go. So, it's too early days to really give you any projections for the quarter. For the full year, we still remain committed. We are still saying that we will deliver a double-digit volume growth for the year, for the fiscal, and we continue to see a mid to high single-digit revenue growth.
I mean, mid to high single-digit revenue growth, volume growth in 10% plus?
Yes, volume growth I do maintain, and as we've also demonstrated in the last quarter, will be double digit. It'll be 10% for sure.
This is now the festive season all the way to the end of the year, and this will be a busy season for you as well, right? Is it too early to gauge whether, I mean, it's really sort of demand inquiries, etc. Is it too early?
It is a bit early because really,
Okay.
I think you normally start seeing the uptick in the first week of September. So September, October, this time Diwali is a little early. It's in the end of October. So that's when you'll really start seeing the uptick. But yes, it's slightly better than what we saw. And I do think that the consumer sentiment, both across urban and rural, is a little better than what we saw in the last quarter.
Okay, so that's the outlook on the volume growth at the top line, Mr. Rajagopal. Hi, morning. Let's talk about profitability and margins as well. And I think the question on people's mind is whether this price hike has been well digested, whether you'll attempt more price hikes as we get into the thick of the festive season, and whether the margins can be sustained. I think first quarter you were close to 16%. So what's the margin trajectory looking at input costs for the rest of the year?
So we believe at this point, Surabhi, that look, we see approximately about a 2% increase in the raw materials. So we are ballpark there on the price increases, and then we obviously will look at some of the commercial excellence initiatives to make sure that we continue to remain in the same band. As I said, our endeavor is now to hold our EBIT margins. We were one of the few players really looking at both sourcing initiatives and cost initiatives to make sure that we delivered a profitable quarter. So we continue to be focused on that journey. Yeah. But I would still say a little early days. The competitive activity is yet to heat up because the season really, in a way, would start between September and October, and that's when you will really start seeing the next sort of signs. So far, from what we've seen for a month and about 2 odd weeks, I think it's fairly okay. We would believe that we are still on the journey.
Okay, speaking of competitive intensity, I mean, that's been the talking point in your sector, right, sir? So what is the sense you get? And you have your ear close to the ground, close to the business. Again, back to the question on price hikes. I think everybody took notice of the price hike because it happened when so many new big players, deep-pocketed players are coming through. So again, the same question, would you expect some more price hikes to be pushed forward? Or is it too early to say? And also tell us about market share. Since we're talking competitive intensity, you want to sort of rise up the ranks on the premium segment side. So what's happening with market share?
So firstly, Surabhi, to the question on price hikes. See, at this point of time, what the sort of inflation on the raw material side we seem to be covered. We'll have to see how the vagaries of the commodity price moves in the next few months, and then accordingly we will have to take the decisions. We want to make sure that we are maintaining our competitiveness while we take the price hikes. We are already a premium brand, as you're aware, and so we want to be extremely careful of the fact that we don't want to. So that brings me to market share. Look, I believe that we are getting market share. We are closer. We in the paint side, we were at about 4.5%. We have all the way moved up to almost 5%. If you look at, we are in the top 2 now over many quarters. If you take a 2 years also, we are in the top 2 in terms of growth, right? And not just growth. Remember, we are a challenger brand. So it's also very important for us to maintain profitability as we start getting those growth. So really a tough act, but yes, we are up to it. We put our strategies in place, and so far, as we've seen in the last quarter, we seem to be on course.
Got that. 2 questions. In terms of touch points and distribution, where are you at, and what's the target by the end of this year? And on market share on the premium side, where are you at now?
So first on distribution, Prashant, we were at about 22,000 outlets. Our first target is to cross 25. You see, our definitions are a little stringent. So when you hear this, we look at outlets with a certain minimum amount of revenue. So our metrics are a little different from how the industry looks at it, and that's only because we want quality outlets. Given the fact that, as I mentioned, we are a challenger brand, so it's very important to make sure that your value per outlet. Yeah, and the same store growth is also kicking in as we start expanding. And your second question was, Prashant?
Market share in premium segment. And what would you like that to go up to? I think you were at about 16-17%.
So I've said we'll go up to about 30,000 outlets. In terms of premium, yes, that was your second part.
Yes, yes.
17% market share. Look, we are continuing. Our premium is really growing, and that's born from our contribution margins. You see, we've got one of the highest contribution margins, gross margins in the industry, and that's what has also, sort of been accretive to our margins that we've delivered. So we continue on the track. What have we done? We've launched, for example, a super premium, uber premium product called BT Eterna very recently. We've just put it in Delhi and Kolkata. We'll be coming to Mumbai and some of the other markets very soon. It is, it's going to be a paint with a stroke unmatched. I can tell you because we've tested it enough, and this is really for consumers who are very who have a very discerning taste, and making sure we continue to serve the high-end customers in a manner that they would like to. So that's really the focus, Prashant, if I've answered your question.
Prashant, are you painting your house this Diwali? It's for discerning consumers, so there's some thought.
I'm hoping that all of you paint
with two kids, I've decided I should do it once every decade. There's no point. Otherwise, I've been doing it every year. But Rajiv, it's a pleasure. Thank you very much for joining us, and great conversation and great speaking with you here on CNBC-TV18. So that's the perspective coming in from AkzoNobel. 15 points lower on the Nifty, 24,685, 90. So basically bouncing around, but not very much in that sense. The big mover is PNB Housing. PNB Housing is up 7%. That block got done in the window, and it's surging as we speak right now. There is Signed, which is looking up. Nucleus, after yesterday's 20% move, is up another 8.5% right now. And there is something like a HG Infra, which is coming up with strong gains as well. But I think we've got the management of Mazagon with us.
Absolutely. And before we get to the management, let's pull up the stock price, because there's an interesting tug of war that's been taking place in the market since yesterday between the bulls and the bears on this stock. The stock started off a little soft. It's recovered quite well. Mazagon is actually down about 25% from the peak. And yesterday, the decline was a little more pronounced because of a note that was there in the market. ICICI Securities put out a report. The target price was substantially lower than where the stock is trading at right now. The target price is close to 1,100. And, there's a contention there by that one brokerage that perhaps as the execution of a lot of the large projects gets underway, after FY26, the surge in margins, the EPS, that will all sort of cool down. It will become range-bound. And then the stock will have to perhaps contend with valuations which perhaps could be out of whack. So just summing up that view, which led to a big decline on the stock yesterday. But we want to get an idea about the business ahead and whether any of these concerns are well-founded at all. Sanjeev Singhal, Chairman and MD of Mazagon Dock Shipbuilders, is with us. Mr. Singhal, thank you so much for joining in. So, of course, your business always gets a lot of attention and attraction in the listed markets. And we want to start off with exactly that. You had a fantastic first quarter. Your margins moved up to 27%. You've been delivering ahead of schedule on a lot of the marquee deals and the marquee names. But the concern is really that whether you will be executing most of your order book by FY26 and what happens after that. So let's start by getting the order book picture. Where do you stand? What is the addition? And how much will you grow the order book by this year? And what is the execution timeline?
Yeah, good morning, everybody. With respect to the company fundamentals, we would focus only on the fundamentals. As far as the order book is concerned, we have a current order book of around 40,000 crores. Recently, we have added 4,600 crores of a offshore project from ONGC. Last year also, we received fresh orders worth approximately 7,000 crores. So if you look at the order, the number of vessels which we are executing today, we have orders for around 30 ships which are to be delivered over next couple of years. And apart from this, I have mentioned earlier also in a very transparent manner that we are poised to receive one more order with respect to additional 3 Scorpion submarines, for which costing committee has had 2 rounds of evaluations, and we believe that they are close to submission of their report. And subsequent to the submission of the costing committee report, there would be, if required, any technical or financial negotiations. And we expect this order to be placed on Mazagon Dock anytime soon. Apart from this, there is an order for P-75I submarines with AIP fitted, where MDL is participating along with TKMS Germany. As per the reports available with us, the field evaluation trials of Mazagon Dock Shipbuilders and TKMS have been found to be successful. And this project also would be progressing at a desired pace. So maybe next year we can expect positive developments on this account. Apart from this, also,
sir, if you just allow us to interrupt you, sorry for that, just to understand the nuances. Some questions, one step at a time. You said the order book right now is 40,000 crores. That includes the delivery of 30 ships over the next couple of years. You will execute this order book over what period of time? And in terms of revenue recognition, what should we expect in FY25, FY26?
I'll not be assigning any numbers for FY25 right now, but yes, we are looking for growth over 23-24. And this order book, we plan to execute over a period of next around 4 years. And then there would be certain pendings with respect to the D448 liabilities and the warranty executions. So maybe 4.5 years, 5 years, this order book would be liquidated. But at the same time, we are expecting substantial orders in next in a short while. Yeah, I would say.
Okay, let's
maybe next 2 to 3 years. So before we execute the order book, the fresh orders should be in place.
Yeah, no, absolutely, Mr. Singhal. Good morning, Prashant here. Yeah. And I mean, it's been such a wealth creator, the stock over the last couple of years. But we'll talk, of course, only about the business. So let's talk about that P75I submarines, right? Six in total. You've submitted bids. You're saying that what you've submitted has been found to be satisfactory. I think you told us that the order value there is about 43,000 crores. By when can we...
the AON value as on 2018 is 43,000 crores.
Yeah, absolutely. By when will we see something this year? Or you said the final award will only happen next year?
Yeah, we are expecting next year.
Next year. First half, second half?
Such fine timelines would be difficult to define because a lot of procedural issues are there, a lot of agencies are involved. These are mega projects. But yes, positive developments in the right directions are happening. So if things are moving as per schedule, then we expect sometime next year before December, orders should be in place.
And how many, there is a private player in a JV also in the fray, right? What would your expectation be? You've submitted for all 6, but typically, how does this happen? I mean, if there are 2 players who submitted bids and both are found satisfactory,
As far as the RFP is concerned, the entire lot of 6 submarines will be awarded to only one of the consortiums. Mazagon Dock Shipbuilders, considering its strength, is very positive about it.
No, absolutely. Get that. You before we spoke about the submarines, you were talking, you started with another large value sort of bid.
For 3 submarines, just clarity on that, sir. So P751 is separate.
That is next year.
That's next year. You said that there is another large order for 3 submarines where technical studies are undergoing. Can you tell us more about this contract, the size, the potential, and by when perhaps, we can get the final word on it?
Yeah. Currently, we are executing P75, which comprises of 6 number of Scorpion submarines. We have delivered 5, and the 6th one is scheduled to be delivered by this year, probably by 3rd quarter of this year. And in a continuation of the same P75, there is an additional discussion with regard to 3 more submarines of P75, Scorpion submarines. So these 3 submarines, we have already submitted the technical as well as the financial documents to the ministry, and this has been evaluated by the costing committee twice. And we believe that the costing committee is close to finalizing their estimates and assessments. So this is likely to be finalized, and this could happen very soon if things go as per schedule. So this is on nomination basis and likely to happen very fast.
And this is and what's the value, sir?
A1 value would be something around 27,000 crores.
And that should happen. I mean, the award should happen this year. Over the next couple of months.
Yeah.
Okay. It's possible that by when we are speaking with you same time next year, of course, That's not the next conversation we'll have. We'll have hopefully many between. But you will have, that 43,000 crores and this additional, which is expected to be awarded in the next couple of months. I mean, we're looking at a sizable accretion possible.
With respect to the first 3 submarines, we are absolutely positive that it should definitely.
But that's nomination.
To that. With respect to P-75I 6 submarines, I said we are hopeful by December next year, things should be in place.
Okay, things should be in place.
All right. So now that we've understood the way the order book is shaping up, just a word on revenue recognition, because I'm going back to market concerns and the concerns could be based on stock valuation, but just to understand the business mechanics, one of the contentions is that as you go on executing this order book, revenue recognition is based on certain milestones. So maybe the pace of revenue recognition will slow down. Maybe the margins will come off. I mean, you're at 27% in Q1 of FY25. So just tell us, as you execute these large orders, what is the revenue recognition and what happens to margins? Can you sustain 27%?
We have never said that whatever margins are there, these will continue as it is. It will depend upon the order profile. But yes, what I can say is currently the position is reasonably comfortable. And because these projects, with respect to destroyers 15 Bravo, this is coming to a fag end. We are out of 4 destroyers, we have already delivered 3, and we are scheduled to deliver the 4th one also this year. So this project would be closing. So any cushions which are kept with respect to liabilities that may arise, the cost to completion, this is reworked on a quarterly basis and every year in a much elaborate and granular manner. So if any cost savings are there, they are released as profits. So this kind of a scenario would continue. Whenever a new project is there, during the initial stages, normally the cost estimation is on a conservative side. It may not be absolutely accurate until the orders are formed up and placed. But as we progress into the project, a greater clarity emerges and we are more aware with respect to at what cost we'll be able to complete. So revenue recognition in case of large projects normally happens in this way. So I don't see, I'm not saying that the margins at the rate of 27% are going to continue, but yes, I definitely see whatever projects we are participating in, a reasonably healthy margins are catered for.
So what is healthy, sir? What is a realistic expectation to have? Not 27%, you've clarified that, but what could be reasonable, sustainable on a full year basis on margins?
See, it would depend. We are a cash surplus company. There are no working capital concerns, and there are no liabilities in the form of debts or any loans. So, with respect to the investments, also there is a sizable accrual in the form of interest income. And as far as the projects are concerned, projects may reasonable margin would be something around 10 to 12%. And taking the repair verticals, the offshore projects, which we have now started in a significant manner, without assigning any numbers, I would say that anything about 10%, 12% would be a reasonably healthy margin.
The offshore project, you're referring to the ONGC one, right? So we're running out of time. But just to understand, I mean, the large chunk of the order book, obviously it's all naval right now. Is there a conscious sort of effort to go beyond naval projects as well? Will we see more of these ONGC type projects? What's the revenue mix that we can expect, say, 2 years down the line?
Yeah, definitely. MDL was in offshore business around 22 years back. So this is one vertical which we are now revisiting and reviving once again. So this would be a separate revenue stream in addition to the naval projects as well as the commercial ships. We are also looking at the repair and maintenance sector. Although these sectors, like repair and maintenance, we don't target more than 8 to 10% of our total revenue pie. And similarly, with respect to ONGC, of course, with respect to offshore, this can be a significant contributor to our revenues going down the line. Because we see a lot of potential in this, and there can be a long-term. We see a long-term engagement in this area.
Okay, and so just checking. I know you won't really tell us much on this, but in case you've heard anything, in New Delhi, anywhere around you, any talk of any stake sale by the government? Anything from Deepan that you may have picked up in conversations?
That would depend upon DIPAM only. So whatever are the directors from the DIPAM side, we'll abide by that.
All right, Mr. Singhal, we'll leave it there. Thank you very much for your time. Appreciate you joining us and running us through all of that in a detailed fashion. That's Mazagon Dock with Perspective. We'll take a quick commercial break here. We are back with more. Markets, I think, also swung back into the green. I think last I saw flattish, but off the lows. Manisha puts the focus on commodities. Stay tuned.
Welcome back. Well, let's now turn the spotlight to the market once again. Very, very range-bound and choppy in a narrow range. That's what we've seen so far. Mitesh is back with us. Mitesh, what's the advice and what are the trades now?
Yeah, so we're still looking at stock-specific trades. Alchem Labs, Alchem is something which is on my focus. It's been consolidating sideways for the last many days, and today showing signs of continuation on the upside. So keep a stop at about 57.15. Look for targets of 5,900 plus here. I think the stock can do even higher because it's at all-time highs. So it looks very positive to me. And the other one is Naukri Limited, which is Info Edge, which is also gone into sideways consolidation for the last 3-4 days, and this can now be bought at a stop below 73.60 for targets of 75.80.
All right, Mitesh, thank you very much for that. So those are individual trades coming in. Commodities in focus. Manisha is here with what she's tracking. Manisha, good morning again.
Thank you for that, Prashant. Well, I'm looking at the soft commodities. Well, the agriculture commodities have been quite volatile as well. In the Indian markets, we're, of course, looking at festival demand, the monsoons and the sowing numbers and various measures that the governments have taken. In the international markets as well, it is pretty much the same, the kind of measures and the weather concerns that we have seen for many of them. So I have a couple of gainers on my radar right now. I'll talk about Arabica coffee, which the prices are trading at almost 2011 highs. This is after drought conditions in Brazil, which has concerns about yield there. And also because of the strong Brazilian real, you have discouraged exports coming in for that one. So this is one thing that has been surging up. The other industrial commodity which has picked up in recent few months has been the rubber prices. 2-month highs on this one. There are supply concerns on production. Logistics have continued to be expensive and delayed as well. Thailand has seen challenging weather. Malaysia production has increased, but only by 0.2% as compared to the previous year. And then you are looking at strong global demand for rubber from whether it's automotive as a sector, healthcare and construction as well. Well, that's exactly where the gainers end, because there are a couple of agriculture commodities which have seen sharp declines also. Sugar, for one, is now trading at 17.5 cents a pound. It's a 2-year lows. The weak demand from China, decline in crude oil prices, and then, of course, the fact that Brazil is producing more sugar than ethanol this time around. You are looking at record sugar production coming in from Brazil. Strong crop expectations in India as well because of strong monsoon and higher acreage areas is something that continues to weigh in case of sugar there. Soybean is yet another one. So overall, the edible oil pack has continued to decline. It's a zero duty import that Indian markets have been looking at. So we are looking at soybean prices at a 4-year lows. Palm oil prices at a 6-month lows as well. It's a record US harvest this time around, and the global ending stocks also expected on the higher side. So when you look at the charts for the last 1 year, you will see that decline for edible oil prices. Soybean is down 14%, palm oil down 6%, and sugar prices have declined by 4% in the last 1 month. But then there are gainers as well, as we spoke about. So rubber is up 7%, and coffee up 2%, and cocoa has continued to surge, up 14% in the matter of last 1 month.
All right, Manisha, thank you very much for that. A lot of the commodity action summarized there. We'll take a break. We are back with my colleague Lata, getting you a CNBC-TV18 exclusive. She'll be chatting with the SBI chairman, Dinesh Khara. That's a special conversation you don't want to miss. Stay tuned. Coming up.
Welcome to a very special conversation. Mr. Dinesh Khara would have completed 4 years as SBI chairman when he ends his term next week. The numbers show it has been an exceptional 4 years. The bank's margins, which stood at 2.9% when he took over, now stands at 3.3% and even touched 3.6% a year back. The bank's NPAs, which stood at over 7% when he took over 4 years ago, is now just 2.2%. Of course, net NPA is much lower. As a result, credit costs have fallen from 2.06% to just 48 basis points today as he signs off. We have with us the man of the moment, Mr. Dinesh Khara himself. Good morning, sir, and thank you very much. Many congratulations for an illustrious 4 years at State Bank. Let me start with the first or the last battle that you are fighting. You began fighting bad loans. Now all of you are fighting for deposits. Just what was the message from the finance minister?
First of all, thank you very much, Lata, and for saying all these positive things about the bank. Well, as far as the finance minister's review was concerned, it was on, we have got a system of at least having 2 reviews with the finance minister. And she invariably comes out with the contemporary situation which is obtaining. And of course, we have the privilege of her guidance during that review. And on the top of it, she allows us to speak our ground level situations as well. So I think it's a good way of interacting and also knowing what is happening on the ground and the steps being taken by various banks to tide over the challenges which are there in the ecosystem. So this was the broad theme of the FM's review. And I would say that it was quite an encouraging review which took place.
Okay, well, primarily it has been a war for deposits, and Soumyakanti Ghosh, your economist, has written a brilliant report on the state of deposits. He says the divergence between deposits and advances normally lasts for between 2 to 4 years once it starts. So he forecasts that by June next year, it would be all over, June to October. You agree with that assessment, or it could be over even earlier?
Between deposit growth and loan book growth. I think growth is one part. At what price and cost that growth is happening is the other aspect which cannot be ignored. You know, while in financial institutions and more so in the banks, it's more like it's a trinity. One is, of course, margins. Second is asset quality. And third is a growth. So this is a trinity which needs to be balanced out. So I think depending upon the credit deposit ratios, each of the bank is probably coming out with their own strategies. And those who are in a credit deposit ratio which is quite on the high side, they are trying to garner deposit by all means at whatever cost they're in a position to raise.
That's right.
But there are a few others who are in a position to calibrate the deposit interest rate. Because what is happening is that of late, when it comes to allocation of anybody's saving, and more so particularly after the financialization of savings, what we have seen, that there are multiple options which are available, deposit being one of them, markets being others.
Yes.
And it all depends upon the when it comes to the liquidity, what is the preference for the liquidity, what is the preference for the returns, and what is the preference for the safety. It differs from age group to age group. It differs from geographies to geographies. So that is why, these are the micro markets which have evolved of late.
Yeah. No, I agree with you. Actually, yeah, we have those numbers. You even told us a few days back that CDs are always an option. And bank CDs have now reached 9 lakh crore. So everybody's dipping into the market, the yields being low over there. But Soumyakanti makes another point, which I'm sure may have come from you to him. The tax advantage which capital markets have, now the difference is too biting. Was that part of your discussion with the FM? Do you see anything happening on that count?
No, I think as bankers, this point was raised. And of course, essentially when it comes to, various financial instruments, how tax efficient are they eventually will decide their acceptability with the various savers groups. So it depends upon the target customers. So that is something which was brought out. But yes, of course, it was deliberated, debated. Of course, these things take its own course before any final view is taken.
Yep, we have just put behind the budget, so we can't expect tax changes anytime soon. But I'm sure you all made your point there. But therefore, Mr. Khara, coming back to the business of the day, do you think deposit rates can rise further and margins can dip a little more in the current year? Would you want to change your guidance on margins at all?
No, of late, when it comes to the loan book is majorly linked to either to MCLR or to EBLR.
Yeah.
And of course, when it comes to EBLR, there is a particular set of the benchmark. In fact, all benchmarks are behaving a little differently. When it comes to T-bill, thanks to the government plan for borrowing, that T-bills are now trading low. So that is something, all such advances which are short-term in nature, which are linked to T-bill, so naturally they are priced much lower. But if at all it is linked to, EBLR, which is, or maybe MCLR, which has got a component which comes from the cost of deposit. So cost of deposit again will differ from bank to bank. So it's very difficult to predict whether it will have a overall increase in the loan rates and will it have any dip in the NIMs? Because NIMs, all said and done, is eventually an outcome of the interest earned and interest expended, expenses and interest expenses. So we are also seeing that the loan book is going well, and that also helps us in generating much better interest earnings. So that is also a reality. But of course, I would also like to mention that entities like us, where we have got excess SLR, so when we are growing our loan book, we are actually diverting part of the investment to the loan book growth. So which eventually means that when our yield on investments being low as compared to our average yield on advances, so it actually helps us in generating better revenue also. So that's how it works. So I think it will actually differ from bank to bank. Very difficult to generalize how it will be for the industry as well.
But for your own bank, do you think you will run down your loan deposit ratio because of the LCR? Why do you have to maintain such a high loan to deposit? You can come down even to 105 or 110, right?
LCR, as far as LCR is concerned, of course, we're at about 130. As of now, the discussion paper which has been introduced by RBI, I would say that they are still evaluating the responses from various institutions. It's too early to jump on what is the likely outcome from this LCR related debate. But nevertheless, we, as a bank of our size, we have normally been taking some kind of prudent measures to ensure that our liquidity should be comfortable. So we will. It's more of board mandated guidelines which are there. So I think, and board always keep in mind what the situations which will be obtaining in the market.
Okay. Well, just to look back at the last 4 years, Mr. Khara, what was your toughest moment? What was your happiest moment?
Well, I would say that toughest moments were the time when actually I took over charge during the peak of COVID. It was the second wave which was getting introduced. We were getting into the second wave of the COVID, which actually turned out to be quite lethal too. So ensuring that, more than 20,000 odd branches should remain functional, the morale of the people should remain high, and we should be in a position to ensure that the wheel of economy keeps on moving. So that was the most toughest moment, and I'm very happy when I look back and reflect on that situation. I would say I'm very happy and thankful to the fraternity, SBI fraternity, because they ensured that the wheel of economy continued to move. And secondly, I must also compliment here the pragmatic policies which were adopted at the material point of time by Government of India as well as by RBI, which helped us in ensuring that the critical sectors of the economy like the SME, etc., they could be provided the required support. You know, people have got very short memories.
Yes.
People would have forgotten what the COVID was. But since it is very green in my mind, I can perhaps never forget what all we went through during the period of COVID. The human aspect, business aspect, all those aspects. But yes, of course, I always believed that we should not allow the negativity to cloud our mind. I tried to stay positive, not the COVID positive, but positive in terms of thinking.
I get that.
Yeah, so
No, I
I
get that.
tried to stay positive and ensure that the whole of the machinery should stay positive, and that is something which helped us in navigating those difficult times.
Okay. I have to slip in a last quick question, sir. On the sidelines of that meeting with the finance minister, were you told what is your next position? I don't think they let you go off that way.
No, I think the exposition was, of course, you know, I could really relate with what they were talking about, and I could integrate and synergize my experience into what we should really go forward, what we should do going forward. So that is my own little experience which I could contribute. So I did that.
Of course, I don't think they let you off. I'm sure there are some plans that they may have for you. All the very best, Mr. Karao, for your next innings, and many congratulations for a very, very successful stint as chairman.
Thank you very much, Lata. Thanks a lot. Thank you.
Okay, well, that's Mr. Dinesh Karao, and August 28th is when his term ends. An illustrious career indeed. Wrap up on that note. Chartbusters coming up.